All right, welcome everyone. This is James Orr. It is 6:01. I'm starting 1 minute late. I was in the middle of a story before the recording started. So, welcome everyone. We are doing Little Down Nomad overview tonight. You can see the web address on the screen there if you need to access the information. Oh, Elijah says, I only tell me to start the recording when Jason isn't here. Otherwise, it's Jason's responsibility to tell me to start the recording. Oh, that's great. I'm James Orr, realtor with James Orr Real Estate Services, and Jason is joining us tonight. Jason, would you like to introduce yourself?
Bonsoir.
Bonsoir.
Here from just outside Seattle, Washington. I am a little down no-matter myself.
Yes?
Zero down no-matter, actually.
That's right. That's right. Zero down. Yeah, so Little Down Nomad, since this is the class topic for tonight, and by the way, welcome everyone. We'll get to introductions here, I guess, the next slide. Actually, why don't I do introductions and I'll tell you the story about Little Down Nomad. So who are you and where are you from? The reason we do these live, and they are live, is so that people can come on, ask questions, and use the Q&A interface or the chat interface or whatever they want to do. So if you want to introduce yourself, who are you, where you're from, and then how much money do you think you'll need to do Nomad? And remember, the Nomad model is pretty much buy houses for 10 years. That's the kind of plain vanilla version. So I was going to tell you, Jason, what Little Down Nomad really is. So Little Down Nomad are the guys that, they saw a late night TV infomercial, or they read a book, or they saw, something on TV, or they went to a weekend, free preview seminar that the real estate gurus teach. And they're interested in doing real estate investing, but they don't want to. Either they don't want to or they don't have the money to put 20% down. And so they're looking for ways to get involved in real estate investing where they have very little to put down. That makes sense?
Absolutely.
And there's a really funny story about you and this whole idea of needing money to invest. Do you remember that story?
Oh, yeah. Back in the day.
Is that embarrassing to you at this point?
At this point now, yeah.
Really?
It seems like such a silly question.
I agree. It seems so silly to me every time you used to ask me.
Yeah. So basically at every NCREG meeting and whatnot back in, this was 05, 06, 07 timeframe, every NCREG meeting that I would go to, I would, James would be talking about these different real estate investing strategies. And I'd be like, but James, I don't get it. How do you get the money to get started in real estate investing?
Can you really do this with nothing down? How many properties let's put it this way. How many doors have you bought now with nothing down?
How many doors?
Yeah.
3.
3. There you go. So you've now bought 3 doors with nothing down.
Yeah.
Hey, as an aside, those of you that are privileged enough to be watching the video, my t-shirt, I'm losing a lot of weight, and so my t-shirts are hanging lower on my body right now. So you can sort of see my sort of manly chest area. And I was told that hairy chests are coming back. I waited long enough where now I am actually back in style. So those of you that caught a sneak peek of that realize that apparently I have a little bit of hair on my chest. Total aside. Okay, this is going to be a really crazy night. So getting back to the presentation, Elijah from Fort Collins, nothing down unless you're doing Flush Nomad. That is correct, the new Flush Nomad. That was a story I told before this. And then Donna says, Donna from Fort Collins, as low as free to get started. And that is absolutely correct as well. I just got, for those of you that can see this too, I just got the new versions of the Lease Option Nomad book. This is the book that what used to be called basically how to do Lease Option Nomad in Windsor. And I've retitled it, had a cover professionally made because I have no skills at doing this. But you can now see the new cover and the new book. And it's basically the same material. So if you've already read that book, like last year, anyone who came to the Christmas party got a copy of that. But this book goes over how to do the entire Nomad strategy with just $3,000, which is why it's called How to Acquire a Multi-Million-Dollar Real Estate Portfolio with just $3,000 for Jason. This is like the how to do the entire model with $3,000 down.
Love it.
Okay, so upcoming classes. This is going to be way all over the place now. I really got to focus in because we got a lot to cover. Upcoming classes next Tuesday. We only have 2 classes left for the year, and then I'm not sure what I'm doing for next year. I probably will do some classes, but I don't know if I'm going to do them in the same format I've been doing them in. I might change some things up, so that is yet to come. I need to take some time off and think about things over the holiday. But speaking of holidays, 2 classes left, Jason. Are you ready to do both of them with me? That is the question for the night. So number one, building wealth with real estate using appreciation. This is the class where I prove to you using data and charts that real estate appreciates at the same rate as inflation, and that you should use 3% for your number when you're calculating inflation rates / appreciation rates when you're modeling Nomad. It's possible over short periods of time that it's different than 3%, but over a very long period of time, it really is 3%, and that's why we use that number. So that's the class where I do that in December 5th. And then college Nomad overview. This is the last class of the year, and it is the class where if you have young kids and you are trying to save for college because college is becoming very expensive, if you're trying to save for college for your kids and you're doing Nomad, or let's say you are a recent college grad, or maybe even still in college in some extremely rare cases, but let's say you're a recent college grad and you're like, I've got all this student loan debt. How do I pay off the student loans? One of the strategies to do that is to do the Nomad model, basically young Nomad / college Nomad, where you are moving into the properties, and then you're going to start using the cash flow from the properties to pay off your student loan debt until eventually it's completely gone. So that's the
involved there.
What's that again?
Is there some house hacking involved there?
Yeah, you could totally use house hacking to make it even better because you're used to having roommates, most people are, in college. And so why not continue to have roommates until you find a spouse or significant other and you kind of need to move out on your own. Even then, I think there's a compelling reason to try to have another roommate to help speed your growth around. I actually been preparing for another presentation I'm putting together. And one of the things we discovered in that presentation is how expensive long-term care, nursing home essentially stuff is. And basically it's almost like $9,000 a month is what the new median is for assisted living, nursing home type care. And so if you think about it, if you don't do your saving now and do the Nomad model, and in some cases, decide it's okay to have roommates, you're probably going to have roommates later if you don't do it. So you're not going to be able to afford the single room unless you actually do it now. So you're going to have roommates. It's just a matter of when. You can either have roommates now when you're young and actually do it with Nomad, or you can have roommates when you're older and you're living in a nursing home. Is that a pretty good way of putting it, Jason?
Love it. Yep.
Okay. All right. I'm way all over the place tonight. So those are two classes. Let's jump into it. Jason, what is Nomad?
Nomad is a real estate investing strategy where you buy a home as an owner-occupant using the better owner-occupant financing. Live there for a year, rent it out after you buy a new house, and continue that process until you get rich and retire.
Well said. If you don't know what Nomad is at this point, this is the third class from the end. There's something wrong. You really should go watch some of the earlier videos. All right, I do want to talk about overcoming fear. Because, during this discussion of putting little down in order to do real estate investing, this inevitably comes up. There are some real estate investors out there, they believe, hey, I really want to put a larger down payment down because I want to make sure that the investment is, in their mind, quote unquote, safer. The larger the down payment I put down, the better my cash flow is going to be. And then I have a built-in margin of safety. If the property value drops 5% or 10% or 15% or heaven forbid 20% or more, then I've got this cushion of equity that I'm kind of building up, and I'm really not my value is not below my loan balance. And then there's other people that believe just the opposite. They say, why would I want to go and risk $60,000 and put into a deal? The less that I actually invest in the deal to begin with, the less I'm putting at risk, and the more likely I am to feel more comfortable about property values going down and things of that nature. And I'd rather have $45,000 in cash reserves and I put up $15,000 rather than put up $60,000 and have nothing in cash reserves. I tend to be, which is really weird when I say this. I caught myself about to say this, and I'll tell you, I have very different feelings about this. But on one hand, I actually totally 100% agree that you should put the minimal amount down, hoard as much cash as you can on the side so that you have really good cash reserves. You're prepared for emergencies. You've got good holding power. I totally want to tell you to do that. But then on the other side of it, I'm a big believer in pay off your properties. So I guess the in my mind, the split off is long-term, pay off your properties. But when you're buying properties to begin with, let's go ahead and take control of the asset with as little upfront as possible, and then keep as much cash on the sideline as possible to kind of hold that. And then you're prepared, if you need to, feed the property for a little bit of negative cash flow if it really comes down to it, which in most cases we're able to offset with appreciation and stuff like that. Go see the other classes we taught. But I think in that way, I like that better. So there's just two thoughts. More down, they consider that less risky. You have improved cash flow, you have a margin of safety, or invest less to begin with. The less you're putting down, the less risk you have, the more in cash reserves you have, the better off you are. So there's two different opinions. I am of the opinion you should put the least amount in and actually take on more cash reserves and that kind of model. Does that make sense?
Yeah, I'm giggling a little bit because you just said that you're all in favor of paying off the property.
Yes.
But I distinctly recall on many occasions you kind of chastising me a little bit because I have this goal of wanting to pay off my mortgages faster than 30 years.
I agree. So here's the difference. And I'm glad you brought this up because it's actually a really interesting discussion point. I think you should work toward paying off your properties. However, do not take your spare cash, your kind of war chest, your hoard of cash that you have sitting on the sideline to protect you from, unlikely events and, roofs and water heaters and everything else. Do not take that money and pay off the mortgage prematurely.
Right.
If you get to the point where you have enough cash outside of that and you can pay off the entire mortgage, that's okay. But do not I'm going to put an extra $100 a month or $1,000, every couple months or whatever it is. Don't do that, in my opinion. I'd rather see you take.
That's what I'm doing.
Right. And you know something? You're probably going to be okay, right? But I'm just telling you, like in an ideal world, that's what I think is the best practice is actually hoard all your cash and be prepared for downside. I mean, be prepared for something shifting in the marketplace. And I'd rather see you have an extra down payment and buy another property than for you to be putting $100, $200, $500, $1,000 a month into a deal only to find out later that you're short to do your next Nomad property. Right. It is more important for you to do your next Nomad than to pay down your mortgage.
I will concur on that.
Okay. So as long as we're in agreement, and real estate is really forgiving, especially when you put a really long time horizon. You tell me you want to do something the next 6 months with real estate, I get a little nervous for you because who knows what the market's going to do in 6 months or a year or 2 years or 3 years. You tell me you have a 20-year time horizon or a 30-year time horizon, I'm like, yeah, you almost can't screw up, right? Because over a very long period of time, real estate tends to keep pace with inflation. And sure, 5 years from now, we can have a little market correction. We can have a big market correction. But look at Greeley. Greeley, Weld County specifically, led our state in foreclosures. It was like one of the highest foreclosure counties in our state. It actually was the highest foreclosure county in our state. And during that time, it dipped quite a bit. I don't know if it was quite 50%, but looking at the chart, it looks a lot like 50% to me. And so the market value in Greeley went way down. But now, 10 years later, 7 years later, 8 years later, the market has completely recovered, and it looks like I look like a fool for telling people, be careful of Greeley. Right. Because, Greeley during the downturn got hit really, really hard, and it was largely an oil and gas kind of city, and, there's a possibility it could correct. But if you tell me you have a 20 or 30-year time horizon, I'm not even worried about that. If you tell me you're going to be in and out in 3 or 4 or 5 years, I get nervous for you because it's possible you could have another little small market correction in Greeley. But even then, the market goes down, the market goes up, the market goes down, the market goes up. And overall, because of inflation, it costs more to build these properties. Eventually, it goes up at about 3% per year. That makes sense?
Yeah, absolutely. You know what, James? I'm willing to bet that you have some amazing charts to demonstrate this entire principle for us.
Yeah, but it's not in this presentation. I do have charts on that, but not here. So that's very funny. All right, so Little Down Nomad overview. So who is the Little Down Nomad? I think I covered part of this. Real estate investors who want to get involved in real estate investing, but either, number one, they don't have a large amount of money to invest, or B, they don't want to use a large amount of money to invest. So it's possible that you don't have it, and so you're just doing what you can. You're doing Little Down because that's the only option you have, and it's better to buy a house and have the house save for your down payment than for you to try to scrimp and save and do it all by yourself. Leverage the ability for your houses to make money, in my opinion. Or maybe you do. You're sitting on some big cash reserves. You're like, I want to keep a big war chest. I agree with James. I want to have a couple $100,000, $500,000, $1 million in cash or stocks or wherever else. And I actually want to do this. And I'm going to test the waters. I'm going to go in. I'm going to do my first property. I'm going to put $15K down. I'll do 3% down loan or 5% down loan. I'm just going to buy something and I will make it work. But I'm going to keep all my cash on the sideline because I feel much more comfortable having big hordes of cash and not having to use a larger down payment. So it could be either one. Traditional real estate investing for cash flow and wealth building is typically putting 20 to 25% down to acquire buy and hold rental properties. But let's start off by looking at what it would look like if we basically used our Nomad model, and instead of doing the 5% down or the 1% down or whatever it is, let's see what it looks like when you put 20% down. And then I'm going to compare 20% down to doing more of a traditional Nomad, and we're going to look at the difference because I want you to understand the choice you're consciously making instead of putting 20% down to put 5% down and what the difference looks like. Does that seem fair?
Awesome. Yeah.
Okay. And so tonight what we're going to do is we're going to go over basically the same numbers I used for the catch-up Nomad model. If you remember that class, and if you don't, there's a link to it, using the $286,000 property. And this property is a little bit more expensive now, but instead of updating all the slides, I actually use the same numbers we used in January or February whenever we taught that class so that you can see a side-by-side comparison. So if you go back and you watch the Catch-Up Nomad class, I didn't change any of the numbers except for the down payment amount. Everything else is identical. So you'll be able to compare sort of apples to apples. So here are my assumptions again. $286,000 property, $1,825 per month in rent. I will tell you, I bought 4 of these properties. So these are real numbers. I bought the 4 properties for like $286. In fact, I think I bought 3 of one of the models and 1 of the other models. So one of them was a little bit more expensive, but they're all very, very close. And then the initial monthly rent, I think we got a little bit better than $1,825 and some of them, and about $1,825 on the others. This property happened to come up for renewal very recently. One of the tenants moved out, and we just re-rented it. And the rent we got on it now, I think, is $1,850. So it went up, about $50. It went up about $25 or so. And I think we're getting additional pet rent too. So did we just lose somebody? What was that little beep thing? Oh, I think we lost Jason. So when Jason comes back on, we'll keep going. So basically, the initial monthly rent, $1,825. The home appreciation rate, we've been using 3%. The rent appreciation rate, we're using the same amount that we did as we did the home appreciation, which was 3%. Jason, did we lose you?
I'm here.
Okay, because we had like a little chiming thing go on. Seller concessions, basically the seller is going to contribute to our closing costs, and we're using 2% for that. And the amount we're getting from the seller for seller concessions is the amount we need for closing costs. So that's why it's closing costs equals seller concessions. And then the down payment percentage, this is the one I changed from the Catch-Up Nomad one. We're using 20% down here. And then the interest rate that I use is 4.5. When I recorded this class the last time I taught it, I had just closed on a property with a client who bought basically the same model as well, and he had 3.875. Interest rates have gone up a little bit. I think the interest rate, I'm under contract to buy a property, the new version of this. Basically, it's the same exact house, just in a different neighborhood and a little bit more money. And I'm under contract to buy it right now, and I think the rate we're getting quoted for interest rates is like 3.875 or 3.75 or something like that. So the interest rate, I think, is conservative.
Is that owner-occ?
It's investor.
Interesting. Wow. Okay.
Yeah, because I'm not moving in. Yep. The HOA, there's no HOA in this particular property, but there is a metro taxing district, which acts a lot like an HOA. And so the property tax rate's a little bit higher. Normally on a property, we'd use 0.6 or something like that. In this case, we use 0.75 to bump it up a little bit because it is in that little higher metro taxing district. We set aside 12% of the rents coming in for maintenance numbers. So, a little bit of money is being set aside every single month to handle things like, carpet and, getting a plumber out there occasionally, or an electrician, or fixing something that's broken. So we're doing that. And then property management, we're assuming you're managing yourself. So there's 0% for property management. Excuse me. And then all these numbers down here, yearly college costs, $40,000. We're not using those. College cost appreciation, we're not using that. We'll use those when we do the college Nomad class. So I'm going to show you, if you're saving for college for your kids, what will the college cost be 15, 20 years from now? And you tell me, listen, I went and I called up, the university, I called up Tulane, and Tulane says the college tuition for this semester is $80,000, or this year is $80,000. And so you'd put in $80,000 for your college. By the way, Tulane's really expensive, in case you didn't know. So you put $80,000 for your college cost. You put your college cost appreciation rate, which, by the way, is typically more than your inflation appreciation rate, because cost of college has been rising faster than inflation.
Right.
So when you're modeling this, when we do the college one, you'll see that we do that number in there. And then it will tell you what college costs later on, but we're not doing that tonight. Stock market rate of return, we are going to compare the stock market rate later on. And so you'd use whatever your stock market rate of return is. In this case, we use 10%. I'm putting together another presentation where I'm looking at stock market stuff. And I looked at the Motley Fool's website, and they showed the average stock market rate of return over like a 50-year period, like the most current 50-year period. And their number was really crazy. It was like 5.38 or something like that after inflation. Yep. So I was like really surprised. And so basically we're using 10 here, which is probably really optimistic. So we are going to compare that later. The income tax rate, Jason, you and I have discussions about this all the time. I think that's a little bit high, but you could make the argument that you are taking the money off the top, and so you are probably really getting the highest tax rate that you're in as your discount. Isn't that right?
Yeah, and also you could argue that, yeah, even though it's probably high, you also have to take into account state income taxes.
Yeah. Do you get depreciation offsets state income tax as well?
Depends on the state. In Colorado, yeah.
Okay, that's interesting. I didn't know that. So basically, it has the numbers there for that. If there's any number on this page that is not conservative, it's that one. All the other ones, I feel super, super comfortable telling you it's conservative. Yeah. That's the one that I could actually argue either way. And so I'm really upfront, and I tell you that in advance. I think in some of the slides, I reduced it down to 20%, and I'll show you that later. And then basically you can choose what type of charts you want me to display, catch-up Nomad, and then the inflation rate, we're using 3%. I don't think I use anything to do inflation rate, but later on I can show you what $1 today is like in the future. But I'm not doing that in this particular one. Okay, so those are my assumptions. Let's take a look at what that looks like. So houses, basically this is the value of each house that we're buying. So if we bought one 20% down house, we bought it in year one, we paid $286,000. Basically that house, like think about them as, the same model for sale in the same neighborhood. The next year, those same models for sale in the same neighborhood are going to be worth $294,580. That's the 3% appreciation. Next year, it's going to be 303, 312, 321, so on and so forth. So that each year, the house that we bought in year one is going to be worth this, and the houses that we're buying are going to be worth that. Okay? Or some people get confused on that, so I want to make sure everyone understands it. This is how much in value the house went up each year. So the house we bought in year one went up $8,580 in year one, $8,837 in year two. And so it keeps increasing. And each house that we buy goes up this amount. So if you have, in year 10, if you have 10 of these houses, all 10 of them went up $11,195 each. So basically $110,000 in aggregate appreciation in that year. Okay, which is this is why Nomad's amazing. Why you can actually get really good returns.
Love it.
And then you're paying down debt on each property. And so in year one on the first property, you're paying down $3,691. Remember, this is 20% down, so it might be a little bit less than you're used to seeing. And then year two, you're paying down $3,861, but it's going up a little bit each year, such that in year 10, you paid down about $5,530 in that year. Okay, so that's return number two. Basically, you have appreciation, some debt pay down. Now we're going to talk about cash flow. So if you remember from our other presentations, usually when we have these, so Donna asks, is that principal and interest? So no, it's not principal and interest. It's actually principal only, because you are paying a principal and interest payment, but the interest part of it is going and paying the interest that you owe. The principal amount is paying down on the loan. So the only part that we're really counting when we talk about the total amount of debt pay down is the principal portion of it. That's a good question. So normally when we talk about cash flow, we have, for the first few years when you're doing this property, it's negative because we only put 5% down or 1% down or 3% down, whatever we're doing for the first property or two, or 0% down, as Jason would know. But in this case, we have positive $1,661 in year two. Jason, why do we have 1661 positive on this particular property when every other time we've used these exact same examples, we've been negative? I'll give you a hint. It's the only thing we changed in this model. What did we say we did differently on this one? Remember?
You put some money down?
Put 20% down instead of 5% or 1%. So basically, if you put down 5%, you'd have negative cash flow. You basically are financing your down payment. In this case, we put 20% down. We put a full, almost $60,000 down. And so now we're getting positive cash flow. This is what I mean when I say to you, if you had put 20% down on this property, you would have positive cash flow. I'm showing you that. If you put 20% down, you now have $1,661 positive cash flow on this property on a much bigger down payment. So what's that?
Correct me if I'm wrong, but wasn't the negative cash flow at 5% down, wasn't it only like $1,300 negative or something like that?
Yeah, we're going to go into detail because I'm going to compare the two. I'm going to show you side by side what the cash flow is, 20% and 5%. I'm going to show you the differences between every one of them. And I'll cover that later tonight.
Awesome.
Yep, that's a good question though. So basically you can see cash flow is increasing over time, and that's from rent increasing over time, and your other expenses like your mortgage, your principal and interest part of your mortgage, that stays fixed for the entire 30-year period. Your taxes on the property only go up a small amount. Your insurance on the property go up a small amount. Your maintenance on the property is tied to your rent, so that goes up a small amount. But they're all really, really small compared to the overall rent increasing, and your big fixed mortgage payment is constant. So really, you're making gains by having the property longer. So really, the cash flow on the property starts off positive in year 2. Now, depreciation on the property. In this case, you take the value of the property, subtract out the value of the land, and then you have the value of the building. You take the value of the building, you divide by 27 and a half years. Excuse me. And that shows you it's $8,840 gross depreciation benefit. You multiply that by your tax rate, and you can see I've changed it to be 20% here. So 20% of whatever the tax, the amount was on the previous slide. Now you have $1,768 in cash flow from depreciation. This is the amount of money you either get back on your tax return, or if you adjust your exemptions, you get it back in each paycheck as a little bit of extra money because you're not paying in as much taxes on your tax return because you got that depreciation to offset some of that income. Did I describe that correctly, Mr. Tax Guy?
Close enough.
All right, so you have $1,768 in depreciation on this property at a 20% tax rate. And 20% tax rate is a much more reasonable number. Wouldn't you agree?
Yes.
Okay.
For most folks, yeah.
Yeah. Okay, so here it is. This is summing the total amount of cash flow and the total amount of cash flow from depreciation on one home over 20 years, and I'm assuming a 20% tax rate. So you can see in the slide, the yellow one is $1,768. That's your depreciation in year 2. And then you have your income, $1,661. That's your positive cash flow for a total amount. That's the orange bar, $3,429. So $3,429 total combined from cash flow from depreciation and your green cash flow. And so you can see that increases. In year 3, it's $3,896. In year 4, it's $4,377, and so on. One thing I do want to point out to you is that your depreciation amount is the same every year until year 27 and a half. So year 27, then it changes. It becomes half of it in year 27. Because it's 27 and a half years, and then in year 28 it goes away. Okay, so you could see that it's the same there, but your cash flow is increasing, so the total amount is increasing. Till in year 10, you're making $7,583 per year in cash flow on that property. And realize you're going to have 10 of these properties, although they stagger when you buy them, so it actually grows at different rates. Okay.
Are you going to show the first year cash on cash return?
I don't show cash on cash return in this presentation. Although we have the ability to do that. Premium Nomads can go ahead and go in there and look at the calculations, and I have a cash on cash return number for each year. I don't think I included that slide.
About 6%.
Is that what it worked out to be?
Yeah, 6% the first year.
Yeah, that seems reasonable for a 20% down property. Seems in the ballpark. If you're able to get in the top, over 5% in our local market. By the way, this is market specific. If you're in a different city, different market, like if you happen to be in, I don't know, Florida or something like that, your cash on cash return numbers may be 10% plus. Okay. In our properties in northern Colorado, it's getting harder to get above 0 in Fort Collins. But in other cities like Greeley and Windsor and stuff like that, a really exceptional deal, you can probably push 5. Okay.
Here comes Wellington.
Here comes Wellington. That's right. Wellington's really small. That's part of my issue with it. And it's also really far north. But,
that was a joke.
Yeah. All right. So total cash returns. So basically this shows you now, not sure why my thing just popped up there. Someone had a question. So basically it shows you in year 1, you had some debt pay down. That's the red box. You had some appreciation. The property value went up. And so your total benefit of owning the property, even though you didn't rent it, and so you don't get depreciation, nor do you get cash flow, the total amount of benefit in year 1 is $12,271. In year 2, it's the first year we rented out with 20% down, We get a certain amount from depreciation. That's the yellow bar. We get a certain amount of cash flow, and it's positive because we put 20% down. Then we have a red amount, which is the debt pay down. That's how much we paid down the loan. And then the blue bar is our appreciation. You add all those together, and you made $23,199 in year 2 on a 20% down property. That's a pretty good little investment. You put up, almost $60,000, 55 and change or whatever it ends up being, and you made $23,000 on it. That's pretty good. The return is overall very good on that. And then each year that grows until finally in year 10, you're making about $31,380 on that property. Okay? So you have 10 of those, it's 310.
Where do I get the down payment? I'm just kidding.
I was having like this really weird flashback. I'm like, okay, Jason, how many times have I told you how to do this? And you've done it now multiple times. Oh, that's awesome. So basically, repeat this property. You acquire one property per year for 10 years, which we talked about doing. Then you stop and you keep the properties until you've paid off the last one in year 40. It's the same. It's plain vanilla Nomad, just kind of writing it out in detail. The cash flow, yearly and total over 40 years. I'm going to show you that chart, and I'm going to show you the equity total. And if you need to speed it up, you can always do that catch-up Nomad class. Go watch the whole class. We talk about how to do this in less than 40 years, where you kind of sell off some and keep others. And you can also do the lease option Nomad, which also speeds things up. All right, so let's take a look at some charts. So this shows you the amount of cash flow you have on 10 homes, all 10 properties, over the entire 40-year period. And this is per year numbers, okay? So you can see the cash flow, it almost starts off positive from the very, very beginning because you put 20% down. So we don't have the negative cash flow we're used to seeing on this chart when we only put 1% or 5% or 3% down or nothing down. In this case, we don't have to finance the down payment because we put up the full down payment. We put up almost 60 grand. And so there's really small, but it's positive here in year 2, 3, 4. I guess that's right here. This is 3, 4. So 2 right here, it's really small, but you can see it's actually positive. This positive, and you can see it grows over time. So it's that by the time I could read the first number in year 15, 16, 17, in year 17, it's about $83,131 or $433 per year in positive cash flow. Now you say to me, wow, that's really good. 17 years in, you're making almost $80,000. Realize how much you needed to put up in order to do that, though. You needed to come up with 10 full, almost $60,000 payments. It's like $600,000 in, and then 17 years later, you're making 83 grand. So if you want to do that, the flush Nomad model where you have the 20% to put down, you don't have to move in either. You start renting from year 1. Don't move into the properties unless you want to get a little bit better interest rate by doing owner occupant. But there's really no benefit of the lower down payment because you're flush. But if you're flush and you have that money, you just have $83,000 in cash flow, and it keeps growing. By the time you get to year 30, you're starting to pay off one property every year, and so your cash flow accelerates from there until finally in year 40, you're making almost $500,000 a year in free and clear cash flow after all expenses, because this does include taxes, insurance, maintenance on the property, and vacancy.
That'll pay for some pretty nice assisted living.
It will. Now, actually, I'm so glad you brought that up because I had forgot about this. So here's the interesting thing. That's assisted living. So let's just do some really rough math in our head, and I hope you guys will follow along. If you don't, write it down, and we can go through it later. But here's the thought process. If you have $1 million in cash sitting somewhere, and you're able to find an investment where you're able to get a consistent, safe 5% return on that money, $1 million in cash will generate about $50,000 per year in cash flow.
Right.
So you need $2 million sitting somewhere getting 5% return in order to generate about enough money to pay for an assisted living room for one. If you're married, you need 2.
Yep.
Okay? So what's crazy about this is now all of a sudden with this Nomad model, buying 10 properties 40 years in the future, you're able to generate $487,818 in free and clear cash flow after all expenses that you could use for assisted living. Now realize these are inflated dollars. So the number I quoted for you today on your assisted living home is today dollars. And so really, I'll tell you the rough rule of thumb for converting 40 years in the future money at 3% to today's dollars is about 1/3. So 478 looks an awful lot like 480. 480 divided by 3 looks an awful lot like, 160. So $160,000 a year in free and clear cash flow from doing this.
In today's dollars.
So it'll cover about 1.6 of the assisted living, 1.7 of the assisted living amount that you would need to do it. Now realize too, you're also sitting on 10 free and clear properties that are probably worth about $3 million in today's dollars that you could tap into to make up any difference,
Right.
or finance one of them, pull out money with cash. So just doing this Nomad model does give you more than enough that you need for the assisted living stuff.
Right.
Okay. And if you're doing Nomad and you're only coming up with, $3,000 for the first property and you're using, lease option stuff in order to acquire the rest, would you rather, I'll ask you another question now, Jason, ready? Jason, would you be willing to give me $3,000 today and you do a little bit of hustling and work in order to make, the lease option model work in order to completely pay for your assisted living in the future?
No.
Yeah, you get the idea. So instead of actually having to save for this stuff,
Right.
it becomes much, much more compelling. So yeah, I appreciate you bringing that up because it's kind of good tie back in. All right, so now here is the cumulative amount. So if I add up all the cash flow you received to date and I add up all the equity you have in the properties at that point, this shows you both the equity amounts, which is the blue line. So, by year 15 or so, you're at let's try to make it work out. So year 14, it looks like you're at about 2.5 million. Year 22, you're at about 5 million. But you can see that the equity you've got is pretty significant. And then the cash flow on all these properties is increasing as well, such that by the time you get to year 40, you've accumulated $5.8 million in cash flow over that time period. So you can almost think of it as, you could have taken this cash flow and then used it for your down payments or used it for paying off the houses faster and actually accelerating your stuff. Because a lot of times when we're talking about the Nomad model, we're not taking the extra cash flow into account. We're not saying you're getting cash flow from these properties, let's use that for down payments. We're not doing that. We're trying to be conservative when we do our modeling.
Your normal catch-up Nomad model is based only on increases in your salary.
Increases in your salary.
Qualify
Not sure.
for future loans. Is that what
We
you're
do
saying?
use the income required in order to qualify for the loans based on debt to income. We do that calculation, but we don't use the extra cash flow you have to pay off the houses. There's no modeling I've done yet in this stuff in any of the classes where I say, let's take any positive cash flow we have and dump it back into the properties.
Right.
I've never done that.
Right.
So it's always been more conservative. You'll be able to, another way of saying that is you'll be able to spend all the cash flow we're talking about generating here and not have it affect the model.
Right.
Okay.
Although
So use it for vacations or use it to hoard money or use it for, and putting more money in the stock market or whatever you want to do. You're welcome to spend that money. You do not need to save it.
Let's say buy more houses.
You could buy more houses too. Sure. But if you save it, you'll be more conservative. You'll have a bigger hoard of cash sitting around for a rainy day, but it is not required for what I'm teaching. Okay. So it's conservative in that way. All right. So what will it take to do this? How much income will you need? Most of the time a job, but it can be assets if you've got a bunch of assets. We're going to see the next slide for the amounts on that. How much down payment do you need? We've been talking a little bit about that. I'm going to show you the actual amounts on a slide. And then we will discuss how to make this little or nothing down. And then credit. First one can be done with FHA as low as 580 credit score. You could put 20% down with the FHA loan, but you can do it with 580 credit score. And then additional conventional loans require higher credit scores in order to do it, but you'll have time to improve it with the Nomad model. So even if you have a 581 and you're trying to work it up, you'll buy the first one and then you'll have a year in order to do the next one. You have some time to improve your credit. Okay, so let's talk about income. So in order to do the 20% down model, buying these $286,000 houses, you'll need $2,914 per month combined income, assuming you have no other debt. If you have other debt, it basically rises by whatever your monthly payment is, times like 2.2 or something like that. So in other words, if you have a $200 per month car payment, you need to add like $440 or something to your payment, to your monthly amount here in order to cover that car payment in addition. Okay, this is assuming you have no other debt. So any other monthly obligation debt you have, you need to add it to this. Car payments, student loans, revolving credit lines, things like that, all need to be added. But otherwise, you need a little less than $3,000 to do the first one, a little more than $3,000 to do the second one. I think it peaks out in year 5 at like $33, $38 per month for your entire family if you're doing this. So 2 of you working with no other debt in order to be able to do it. So it's very affordable. Okay. Didn't you write a great article once that was like, how to do Nomad on like $7 an hour?
$10.10 an hour, which is the federal employee minimum wage.
Okay, but you can do the entire Nomad. You documented how to do the entire thing with $10 an hour.
Yep.
Okay, pretty impressive. So how much did you invest each year in order to do this model? Well, you started off to buy the first property with $57,200. And you're like, oh my gosh, James, I thought this was a class on little down. $57,200 does not seem like a little down amount. Would you agree?
Agreed.
Yeah, and so what we're trying to do is compare and contrast. This is the traditional model. This is what the gurus are teaching. You know, go flip houses or do wholesaling until you come up with a big down payment and then acquire your rental properties. I think that's a bad plan. Okay, I think that you should actually be doing Nomad. You're putting little down, acquiring your rental properties. You don't need to do the flipping and wholesaling. You can skip all that crap. Okay, so 57.2 is what you need for the first down payment. 58, almost 59 for the second one. All the way up to year 10, you need about $75,000 for the down payment for that one. Okay, so these are the expensive 20% down models that we're going to compare doing Nomad to. You'll also notice when I show this chart when I do Nomad, I often add in any negative cash flow you have, because I want you to understand how much you would need in both the down payment and the negative cash flow in order to be able to do the model. In this case, since we have positive cash flow because we're putting 20% down, there is no negative cash flow to offset.
Right.
So we're not adding it in there. Okay. So this is the total amount invested cumulative when you add all of them together. And you can see just keeps adding and adding, adding. The total amount you'll need in order to do this deal is about $650,000 or $670,000, whatever it works out to be. This line showing you don't have to need to invest any more, but it needs about $500,000 in order to do this. So here's the interesting question. You've got somebody who had a traditional retirement account. You know, they were an engineer at HP or Avago or Broadcom or CoreLogic or whatever it is, okay? And they've actually been saving in their 401k or got stock options or whatever. And they're like, you're looking at this, they're like, I would like to actually accelerate this and maybe diversify out of the stocks and do a little bit of real estate. Does $600,000 for doing this whole entire model seem really, really crazy high for someone like that? And in some cases, no. I mean, they may have, at age 40 or whatever it is, they may have saved up $500,000 in their retirement account. And what I'm suggesting is, take a little bit of that, siphon off $60K or $56K or whatever the number was, and buy one property. If it makes sense after the next year, buy another one. If it makes sense after next year, buy another one. Until it doesn't make sense to you, you keep doing this. And you decide, I want to diversify out a little bit, so I'm going to take 10% of what I have stocked away and do that. And eventually, in order to do the whole thing, get 10 properties, you need to have about $670,000. That make sense?
Absolutely.
Okay, cool. So in an ideal world, you'd have enough for all your down payments, any negative cash flow, and cash reserves. If you don't, there are options. Okay. So it's about $60,000 per year for each house. What if you don't have $60,000 per year to invest in buying 10 rental properties? What if you don't want to invest $60,000 per year in buying 10 rental properties? This is where we start transitioning to little down Nomad. And here's where I do my really sleazy sales talk. So I'm going to pretend, Jason, for a moment. Here we go. Ready? Jason, what if I offered you a way for you to finance all or part of the $60,000 down payment over time? Would that be interesting to you?
What's the catch?
There's no catch. It's amazing. Okay, so that's my sleazy sales talk. But it really is. It's like, listen, if you don't have the $60K, what if I told you I'll finance it for you? I'll show you how to actually do the deal where you don't have to come up with all of it. You just make monthly payments for a period of time and do that. So let's take a look. So instead of putting 20% down, $60,000, you're going to go put a smaller down payment into the deal. And there are 0% down loans. Jason, what are the 0% down loans, Jason? I know you know at least one of them.
VA, USDA.
Yeah, VA loans for veterans and the USDA loan for more rural property. So you have to go to Windsor around us in order to do that and find out what they are in your local market. But you can do 0% down there. There's a 1% down loan program, which is sort of a misnomer because it's actually not a full 1% unless you're below a certain price range. But it's really, really close. The lender will credit you up to $5,000 towards your down payment with a 3% down loan program. So it's very close to 1%. So you can do 1% down loan program. You can also do a $1,000 down loan program around here, which is the CHAFA loan. Or you could do straight up 3% down or straight up 3.5% down for FHA for the first house or two in order to do those. And after that, it's probably 5%. But there's a whole book, for those that haven't read it, on how to do the entire thing using just the first property that you're doing. You can either do 0% down or do 1% down or $1,000 down. And that's basically to keep you under the $3,000 to do that. So we talked about those different ones: USDA, VA, FHA, some of them with grant or down payment assistance in order to do these. So instead of having to come up with $60,000, you're able to come up with a lot less, and go watch the whole financing class in order to do that. My video just freeze for you?
Yes.
Okay, good. Well, I'm going to stay in that position for the rest of the class. Okay, so 1% down and 3% down conventional financing programs for the first house. We talk about it there. And remember, when we talk about having the house pay for the next house, that's all about it in the book there. Okay, I'm back. We'll use little down conventional financing for the model, and we're going to talk about the 1% down for the first property. It's about $3,000. And then we're going to use 5% for house 2, 3, 4, 5, 6, 7, 8, 9, 10. So all the rest of the 9, we're going to use 5% down. That's the model we're going to use to compare this 20% down to the Nomad model we're doing. So let's take a look at that. So scenario 1, when we look at these charts, I'm going to have 2 scenarios up there. Scenario 1 is 1% down with conventional financing for house number 1, and then 5% down conventional financing for loans 2 through 10. Okay? And then scenario 2 is that 20% down for loans 1 through 10. All of the ones are 20% down. So we're going to compare and see what the difference looks like for that. All of the other assumptions are completely identical. Okay, so I'm not trying to do any magical shift of hands. All it is exactly the same. Okay. So the value of each house. Jason, if I change the down payment, does it affect how much the houses are going up in value each year?
No.
Doesn't at all. Stays the same for both scenarios.
Was that a trick question?
No, but I want to methodically go through and show you everything and show you, does this change? No. Does this change? Yes. Does this change? Yes. Does this change? No. And so we're going to go look at them all. So really, appreciation doesn't change. House values go up the same no matter you put 1% down, 3% down, or 5% down, or 20% down, 50% down, or 100% down. Doesn't matter. Okay. Appreciation on one home, they stay the same. So all of them went up $8,580 on both. What does change, though, and this one's pretty interesting, is how much debt you pay down. And it's counterintuitive. You'd think, hey, if I put 20% down, it gets better, right? I mean, the returns get better, everything gets better. It actually doesn't. But that's what most people think. They think, oh, it's better to put 20% down. It's not true. So here's an example. Debt pay down. You actually pay more debt off each year when you borrow more money. So if you put 1% down on the first property or the second property, you put 5% down, and you put 20% down on the other scenario, you actually pay off more debt with the smaller down payment one, which makes sense. Instead of owing, if it's a $300,000 property, instead of owing $240,000, you now owe $297,000, and so there's more to pay off, and so you're paying down more each year.
Because both loans are paid off over 30 years.
They are. They're paid off over 30 years. Yeah, and so you could see in this example, the one that had 1% down, we paid down $4,568 in year 1. With the 20% down, we paid down $3,691. So it's a difference of $877 for the year. So it's $877 better to do the nothing down, or the 1% down loan program than it is to do the 20% down loan program. And that actually increases over time. Does that surprise you?
Nope.
Yep. Okay, so that's that. Now, cash flow. We talked before, when you put 20% down, we had positive $1,661 in year 2. But in year 2, with the 1% down loan program, we actually have negative $1,643. So the total difference, if you say, listen, what's the difference between one where I have negative $1,600 in cash flow and the other one where I have positive $1,600 in cash flow, turns out to be negative $3,304 per year. So it's $3,304 better if you had put 20% down more, if you put 20% down instead of 1% down. Okay. And what's interesting about that is, even though the dollar amounts are actually becoming more positive, the difference is always the same.
Right.
So your negative cash flow in year 2 is negative 1643. In year 3, it's negative 1176. In year 4, it's negative 695. By the time you get to year 6, it's positive. But the positive for the 20% down is much bigger. It's 3304 bigger, but it's 3304 bigger in every year.
And that's basically your annual cost of financing the additional down payment.
That's right. That is correct. Yep. It's basically the difference between your principal and interest payment on the two different loan programs. Okay. So your cash flow, you can see it there. So here's the question. In year 2, because you're occupying the property in year 1, instead of getting positive cash flow when you put 20% down, you have negative cash flow when you put 1% down. We've been talking about that. No big surprise. So the way I like to describe this is you are, and I'm using the air quotes here, financing your down payment over time. Instead of coming up with $57,200 in year 1 for your down payment, you came up with $2,860 in year 1. The difference between the two is you had to come up with $54,340 less to do the 1% down loan program than to come up with the 20% down. And I've slowed down because I want to really drive home this point. It's important for you to realize this, okay? So instead of getting $1,661 in positive cash flow in year 2, you're actually paying $1,643 in negative cash flow. That's your financing of the down payment. So really what it works out to be is $136.92 per month in negative cash flow. That's how much you're feeding the property in order to do it. Okay. So Jason, would you rather give me $53,340 today, or would you rather pay in $136.92 per month to finance that amount?
I'd rather do the $136 a month and keep the cash in the bank.
Agreed. And what's more interesting about that is that negative $136.92 goes away much faster than you'd think.
Correct.
Okay. So, the payment amount goes down. So let's talk about that. I think I'll cover this later, so I'm going to hold off. But basically, the amount you're paying in goes away over time, and it's much faster than if you took that $54,000 you divided by 132, which is a long time. In fact, would you do that? Do you have a calculator handy? Take $54,340 and divide by 136.92.
I don't have a calculator handy.
Oh, I do then. Never far away from a calculator. All right, so here we go. 54. I'm good. I'm not that good. Divided by 136.92. So it would take you 396 months divided by 12. 33 years. The mortgage would be paid off before you'd actually catch up. Right. Let me say it another way. Instead of actually putting $54,000 into the deal, if you paid this $136.92 every single month until the mortgage was paid off, you still would have paid in less than if you had paid the $54,000 up front.
Right.
That's crazy. Okay? All right. Let's take a look. So did depreciation change? You bought the same property. Does it matter if you put 1% down or you put 20% down?
Nope.
For the tax benefits, Jason.
Doesn't change.
Doesn't change at all. So it's the same, 8840. And so you're at a 20% tax bracket. You still have the same cash flow from depreciation because we multiply 20% times that 88 number and you get 1768. That doesn't change either. It's the same. Okay. Now here's the interesting thing. This chart's a little bit confusing, so follow along with me as I explain it to you because it's important for you to understand. All right. So over here, this is the deal where we took 1% down. So you have negative 1643 in cash flow. That's that negative cash flow you had when you're financing your down payment. And you had the 1768 in depreciation. That's the depreciation benefit you had there. You add those two together, and your combined monthly, your depreciation, your cash flow from depreciation, and your actual negative cash flow, it's positive 125. So really, the tax benefits, the depreciation you get from buying this property is offset completely by the depreciation. The negative cash flow is offset completely by the depreciation, such that it's positive 125. So you're not even financing it. You're really not even paying the negative. You're actually having it offset by the tax benefits of doing it. The property itself is covering that negative cash flow, in other words.
It's magic.
It's magic, right? And so you don't even have negative cash flow in this case. In some cases you will, right? You'll actually find a property where the numbers aren't quite good enough and you don't have enough depreciation to offset it. And even in those cases, it's still worth doing. But with this case, it's a no-brainer. You actually have enough depreciation, cash flow from depreciation to offset your cash flow completely, which makes it magical. Okay, so that's these kind of three bars right here. Now let's take a look at it. If you put the 20% down, you actually had your depreciation was 1768. That's the red one. And then your cash flow is 1661. You add those together, it's 3429. Okay. And then the difference between 125 and 3429 is negative 3304. That stays the same no matter what. Okay. So that's the year 2. In year 3, your cash flow is negative 1176. Your depreciation is 1768 for a total amount of 592 positive. So between cash flow from depreciation and your actual negative cash flow, it's actually positive 592 for the year. And then the other ones with 20% down, it's 3896. Your difference is always 3304. And then in year 4, it's negative 695 in cash flow, 1768 in cash flow from depreciation, and you have 1073 in positive cash flow combining the two. And then you have 3304 combined. Does that make more sense when I explain the chart like that?
Yep.
Okay, good.
It's laid out pretty good.
Good. And then we're doing the total cash returns. And this shows you debt pay down and appreciation, which is 13,148 on that property. You have debt pay down and appreciation. Appreciation's the same. Debt pay down does change whether you got 1% down loan program or 20% down. And so it's $877 better in year 1 to have owned the 1% down property because you're not renting it. You don't have the negative cash flow offsetting it in year 1. In year 2, it's actually $2,387 worse to own the 1% down property. So it's, in other words, you have $2,387 more return because that's basically the cash flow difference between these two in year 2.
Right.
All right. Depreciation. So for little down nomads, it could be thought of in 2 ways. Number 1, it can either reduce or completely eliminate negative cash flow, which we've kind of shown. And that's one of the ways that we like to think about it. And that's how I usually talk about it for nomads. I use it as, you're getting this benefit from your tax benefit from doing this. It really shows up as cash flow, either on your tax return at the end of the year or monthly or whenever you get paid, basically every pay period, if you decide to increase your exemptions. So I usually use it as a way to offset negative cash flow. Or the other way to do it is say, listen, I am going to feed this property. Every month, I'm going to go ahead and put in that $136 or whatever it is. I'm totally fine with that. I have enough income to do it. It works for me. And then at the end of the year, I'm going to get this big chunk back. It's almost like forced savings from the depreciation benefit that you can then use as your down payment in order to buy properties. And you can think of it almost as, this is probably another nomad model. This is like the tax return nomad, where every year at tax time, when you get your tax return back, you use that as your down payment to buy your next property. It's for people that can't save. You have the government save money for you. Jason, is that a good idea?
No.
Don't make loans to the government.
No.
Yeah, Donna's like, no. All right. So any negative cash flows, you finance down payments. You can look at it that way. You don't get depreciation unless the property is a rental, so it has to be in year 2 when you start doing this. But you will be able to take partial depreciation if you have roommates.
Yep.
Okay. So again, then you repeat this process. You acquire 1 property per year for 10 years. The first property with 1% down, properties 2 through 10 with 5% down. And then you stop and you keep the properties until you paid off the last one. It's the same model we talked about for the 20% down, except we're doing different down payments. The equity at the end, when you go look at it, you say, okay, let me fast forward to year 40. What does year 40 look like with 20% down? What does year 40 look like with 1% and 5% down? Your equity in the properties is identical. There is no benefit to equity with the 2 different ones. You've paid off all the loans. They're all worth the same amount. You have X million of dollars in real estate with one model. You have the same X dollar amount in real estate with the other model. Okay. In both cases, you have both have 10 properties free and clear, and your original down payment no longer matters. It's irrelevant. Okay. Your cash flow, though, was much lower when you put the smaller amount down than putting the much larger amount. In fact, you could think of it as you're putting 25% of the down payments down on your properties. Okay. And we already talked about that. All right. So let's talk about the stock market versus Nomad and how the two compare. So the blue line is what happens if you took all the money from doing, the 1% down and 5% down Nomad model, and you put it into the stock market and you were able to magically get 10% return, which I think is optimistic. You were able to do that consistently for 40 years. At the end of 40 years, you'd have about $5 million in total stock market returns. Okay. And I'm assuming you're reinvesting all your gains on that one in order to get that number. Okay. So it's $5 million. Not bad. You'll take it and end up with $5 million. However, if you do the Nomad model, the red one is scenario 1, which is the 1% down, then the 5% down loan programs. That's the more vanilla Nomad we've been doing. And at the end of that, you have total value for that looks like, I don't know, 14 million and change. Versus if you put 20% down, you'd have about 15 million. Okay. What's the difference? We just talked about this. Jason, what is the difference between the 20% down and the 1% and 5% down ones?
It's the 600,000-ish close to of your down payments.
No, it's actually cash flow. I thought you were going to get there. So the down payments no longer matter. Really where that extra $500,000 is that difference in cash flow you accumulated over that entire time period.
Okay.
Because the down payments, really at the end of it, your houses are worth exactly the same, so you have the same amount of equity. The really only difference you have now is that with one, you made a lot more cash flow over the 40 years. The other one, you made less. And how much difference? $500,000 over the course of 40 years. That's what the amount was.
So in the grand scheme of things, meh.
It's irrelevant. I totally agree. It is irrelevant, yes. So what we'll take to do. So income-wise, you will need to earn a little bit more income to be able to support financing down payments. And I'm going to show you on a slide what that difference is. And then you'll need the actual down payments. I'm going to show you the amounts. So this is the estimated gross monthly income required for both the 20% down one and the 1% down one. So in order to do 20% down in the first year, you need $29.14 per month.
Okay.
In order to do the 1% down, you need $34.65. So you need to be making about $550 more per month in order to do that, to be able to finance it.
Makes sense.
You need a little more income. And that kind of keeps increasing to the point where in year 10, you need to be making about $5,000 more per month to do this nothing down, low down model. Okay, that's not insignificant. It means that you and your spouse need to be making about $2,500 more per month combined to do this model where you put less down. Now, how much is that total? Well, the both of you need to be making $7,308 per month. So each of you need to be making about $36.50 per month, which, let's see, calculator here. Let's just do it actually this way. So 7308 times 12 equals 87,696 per year for both of you, divided by 2. So you each need to be making about $43,848 per year from your jobs 10 years in the future, which is probably some appreciation in there, some kind of regular raises. So Jason, do you know what the average person earns per year?
I was just going to say that the U.S. Median income is about 42,000, I think.
There you go. So you need to be making about median in order to be able to do this model.
So you need to be basically the definition of middle class to pull this off.
Yeah, seems reasonable to me.
Nothing more.
Seems completely reasonable to me, right? Okay. The amount invested each year. So this shows you the difference between the 1% down that you put in and the 57,200, the 20% down that you did in year one. And then we start showing you the negative cash flow you also need kind of to hold this. That's the red boxes. And so in year 11 and 12, you don't have a down payment requirement, but you still have negative cash flow with the low down ones. But the negative cash flow completely goes away in year 13. You no longer have negative cash flow after that. Okay. So it shows you the difference in actual down payment amounts and the down payment and negative cash flow for each one of those. This shows you the same information in a different way. This shows you the cumulative amount. So with the smaller down payment amounts, it kind of grows and you max out around, I don't know, whatever this is, $180,000 total in order to do the entire model versus this model where you need $650,000. So you need about 25% of the down payment amount in order to do it. A lot less. All right, one reason why the rich get richer. One of the reasons the rich get richer is they acquire these assets and the assets themselves grow and make money. Mm-hmm. They use the growth of the properties to be able to help us purchase additional properties. I was reminded of this recently. I have a client of mine, and my client is kind of a young father. I don't think he's married to the lady, the baby mama, but they're like in a long-term relationship. And we kept on discussing, should I save up some more money in order to buy this house, or should I kind of stretch and actually do the down payment and get into something? And we did some math together, and I said, if it were me, I would actually buy the house. I would do it. I would buy the house and just get it done. And here's the difference. If he had decided to wait, the property values have gone crazy around here. Mm-hmm. And so his property is probably worth, I don't know, $160,000 more than when he bought it. And he would have had to come up with more down payment every single year. So he's chasing this line that keeps moving away from him.
Right.
But now that he's bought the property, he's got $160,000 in equity that he can do stuff with in order to apply the thing. He basically got the property to start working for him, where now when he goes to buy his next property, he's able to use 160 plus whatever he put down, plus any debt pay down he had in the property. And he's able to use that in order to go and purchase the next property or two or three or whatever it is, or do whatever he needs to do for his family.
It's kind of like you're either inside the system having it work on your behalf, or you're outside the system fighting it.
Yeah. Yeah. You want to get on the right side, where you're either riding the wave or you're being buried by the wave.
Right.
Yeah. And so basically you have to do that. So we can force savings by financing our down payment, negative cash flow on the first property. You do whatever you can do in order to get one to work. You buy nothing down. You move outside city limits. You do a USDA loan, or you do the 1% down loan program, or the $1,000 down Chaffetz loan program. We do whatever you have to do in order to get the first one. I remember another stat, and I think this is from the U.S. Census Bureau. But the U.S. Census Bureau did numbers, and I figured out what the average net worth or median net worth, I forget which one it was. I think it's average. The average net worth for a homeowner versus the average net worth for a renter. And it's ridiculous. It's like the average net worth for a homeowner is like $168,000, and the average net worth for a renter is like $900. So it's like some ridiculously shifted numbers. And really what it's about is you buy that property and then you let the property do the work for you.
Right.
It's not that homeowners are like better savers. It's just they've decided, hey, listen, I'm going to stretch. I'm going to go ahead and get the first one, lock it in. And then if I need to tap into equity or do like a lease option, no matter whatever it is, in order to get those things, you do that. Okay. So each house from this model will be about $1,768 per year from your depreciation for 20% down. Then once you get to 8 houses, you're generating about a full down payment each year from the tax benefits. So, apparently we had a visitor on the video. So basically you do that. We could refinance and take advantage of appreciation and debt pay down. So as the property value goes up and as you pay it off, you could refi, use the money in there in order to buy the next property and do that. Okay. Or you could use the lease option exit and collect upfront fees, which is what this whole book is about for you to be able to do that. Okay. And you'll probably want to replace the properties as you do that. So as you sell one, go buy 2 more or buy at least 1 more to replace it. All right. So have the house pay for the next one. So this shows you the total cash returns and how using this money could then kind of compound it and buy the next property. And so you want to go and do that.
So basically, go back a slide. So basically buy what? Just from the cash flow, the cash flow and the appreciation, by the time you're 3 or 4 years in, you could do a cash out refi and pull out some money to use as down payment for the next one.
Maybe.
I don't
the tricky part of
recommend that, but
well, I would recommend it if it was the only way to get it done. However, there's another complication, and the complication is being able to do a cash out refi on a property that you're no longer living in, so it's no longer owner occupant. You need to have at least 20% of equity, and probably closer to 25 if you're doing cash out refis.
Right. Okay.
And so using a 3% appreciation per year, it takes about 7 years to get to that 20.
Got it. Okay.
And so that's a little longer period of time than most of us are waiting. Now, if you happen to be in a market where the market's going up 10% a year, 3 years in, you could do that in theory. I would probably look at other strategies first. It probably would not be at the top of my list to do that. Number one, there's costs of doing the refinance. There's some, additional interest rate risk of doing it. So I'd look at other options before I looked at that one. I would do lease option exit before I did the cash out refi.
Oh, really? Okay.
Yeah. Well, because think about it this way. You put the tenant buyer in there, you get to use the money immediately, whether they buy it or not.
Yeah, that's true. Okay.
Right? So you kind of get it no matter what. And then if they cash you out, great. You then take the equity off the table and you can go buy at least 1 more replacement property, if not 2.
Right.
Because you think of it, okay, maybe I had come out of it with 10% equity. Well, now I can go buy 2 more Nomad properties. It basically provides me my down payment for the next 2 deals.
Yep, got it.
Or if you have 20% down, you could buy one without moving in, which is what this whole thing is about accelerating.
Right. Plug the book. Plug the book.
Well, I mean, I just happen to have it here, and I just got it in the mail. So and it turned out really nice. I mean, I updated some of the charts. You know, the cover looks brand new. So I think it turned out really nice. All right, so down payment sources. So where do you get down payment in order to do this stuff? We have a whole class on how to get down payment for Nomad, so go watch that. So this is the really short one-slide version of this presentation. Saving, get a part-time job or an extra job to fund your retirement. You know, how bad would it be, Jason, if you had to go deliver pizzas for 1, 2, 3, 4, 5 years, whatever it took, in order to build up down payments in order to get this whole thing started, knowing that once you do that, your retirement is done?
Worthwhile.
I think so. I mean, you hustle for a little bit. You could almost think of it as I'm working part-time on my fortune in the evenings and on weekends delivering pizzas, knowing that once I do this, I will be able to retire young and carefree.
Yep.
You do that part. What's that?
You may really do some how should I say it, generational resistance to that idea.
Well, you know, I think there are some people. There's, you know, to kind of group any one thing and say that whole group is like that. There's exceptions in every group.
Absolutely.
And so you're not looking for, you know, to have 100% of people opt in. You know, if everyone did that, if everyone was as strong as Superman, Superman would not be amazing.
Right.
You know, if everybody were completely wealthy, then it wouldn't matter. Right. So you really want to go ahead and do more than what the other person's doing. If you're competitive, which I am, in case you didn't know that. All right, so you can do garage sales, yard sales, Craigslist stuff you don't need. Remember, you're going to be moving every year. You might as well get rid of your stuff and get some money for it. You could use your retirement account. I am okay with you taking a small percentage out of your retirement account and using that to buy a property here now and then, even if you need to pay the penalty.
Yep.
Because you're going to get a better return than paying that one-time penalty. So it's worth it for me. I would look at other options first, but if that's really what it came down to, I'm okay with that. I'm less okay, but some people will choose to do this using investment cards, aka credit cards, in order to fund your down payments. And here's how I suggest you do it. Do not do the cash advance model. Okay, that's not what I'm talking about. What I am talking about is, and I don't recommend this, it's way down the list. It's like last resort stuff. But here's how you could do it. Instead of spending the cash you would normally spend on cash for groceries and gas and movies and dining out, all that discretionary income stuff that you could use your cash for, and that a lot of people do use their cash for. Instead of doing that, you move that cash to a savings account that you're going to use for your down payment, and you start building up your credit card balance with those types of expenses instead of doing cash advances.
Right.
Okay. So basically you start then carrying a balance on your credit card, and you hoard your money as a side note. Again, last resort, not my preferred method of doing it. In fact, it's probably the lowest one on the list for me. I would do retirement account over investment cards any day of the week. Lease options, that's this book. Keep plugging the book. But that's that whole thing, and that was a whole class on Nomad with lease option exit overview and how to do the Nomad with 3K. It's another class on that whole topic. And then you could use security deposits when you're getting those from your tenants. That definitely helps kind of come up with your money. And then property equity, which Jason kind of mentioned about being able to do cash out refinances. Especially if property values go up faster than in our model, you'll be able to use those earlier. But that's some down payment sources. Lower investment amounts. So if you're thinking to yourself, wow, James, you know, some of those numbers are pretty big. I don't know if I want to take on $300,000 properties. No worries. You know, you can go to Greeley or whatever it is, the cheaper part of your market, which is outside of the city you ideally want to live in. You're willing to sacrifice a little bit about your location today in order to have a carefree retirement, a peaceful, easy retirement later by making sacrifices today. And so you move to Greeley and you buy a $200,000 property instead of a $300,000 property.
Yep.
Okay.
That's what I do.
What's that?
That's what I've done with my first 2 properties.
Yeah, and it makes sense, right? Because you're not going to be living there permanently. It's going to be a rental area for you. You're going to live there for a year.
Right.
And then buy less expensive property. See the catch-up Nomad where I did this with 150K property. So the one presentation I did a really early one where I did both 286 and 150. And the class went like 4 hours long because I basically taught 2 classes in one night. But basically go watch the one on 150 because I go into a lot of detail. In that model, I think you did $86,000 total invested over the 10-year period, $7,500 for down payment one, and then $9,786 for down payments through 10 at 5%. And then basically 2,375 maximum required monthly income in year 5. So if you kind of look at that, that's the peak number, and you basically need to be making, whatever that is, 24. It looks almost like $30,000 a year. So can you do this on a teacher's salary, Jason?
Absolutely, yeah.
You sure can. Yep.
You just might have to live in Greeley.
Which is fine. That's totally fine, because you're not going to retire on a teacher's salary. You're going to retire very wealthy. I mean, you'll have millions of dollars in real estate and passive income using that model. Except, Elisha says the Greeley Nomad. Yeah. Just put any word you want in front of Nomad. In fact, we should just do like a random name generator and just put because that's where we're headed with this stuff. Okay. Little down Nomad. So we asked before, is this worth doing when we discussed the cash flow? The idea that you're negative $136.92 per month as financing $54,340 difference in down payments. Well, the negative cash flow, financing down payment for scenario 1, this is just the chart showing just the negative cash flow for all the properties combined. And then I'm going to show you a chart showing the entire cash flow for all properties combined. So this is just negative cash flow when you combine all of them, 1 through 10, on the properties for each year. So in year 2, you had negative 1,643. In year 3, you had 2,152. In year 4, 2,195. You know what's interesting about this? I'm showing you all these negative numbers, right? And by the way, that's the worst year. Year 4 is the worst year. But what's interesting about it is every single year, this number is offset by cash flow from depreciation. Right. So you're really not even negative. Even though I make this big deal of it because I really want people, there's a reason why I never teach these classes with long sleeves. I want you all to see there's nothing up my sleeves. There's no tricks. This is not mathematical magic where I'm kind of saying, well, you can do this. And I'm carefully choosing my words to make sure that, you're not thinking, oh, but he really isn't talking about this. I'm not doing that. I'm showing you warts and all. This is the negative cash flow you would have on the property, but it doesn't even really exist because you have a positive depreciation, cash flow from depreciation to offset it. But I want to show you, this is the ugly part.
I think one way, a good way to look at it is this is the negative cash flow. You're paying this red number on divided by 12, and you're paying that every single month.
Yep.
If you do not make the necessary adjustments on your W-4
right.
at your job to change your tax withholding at your employer.
Yes.
But then you get it back at tax time.
That's right. That's one of the things we said earlier. Yeah, you're absolutely right. Yeah. So this is the negative cash flow each year, and this is all 10 properties combined. This is not one property. This is the whole thing, okay? The negative cash flow you'd have on all the properties. And again, it's offset by cash flow from depreciation. Now, this shows you the sum of all the cash flows by year when you do this. So you start off originally with negative 1643. Actually, let me see this. Yeah, see negative 1643, 2152. So you can see each year it shows you the total negative. By the time you get to year 7, you actually have positive cash flow from the early on properties that even offset the negative cash flow on this one. Another way of saying that is, you can see in year 7 here, we have negative 1639 in cash flow. That's just adding the negative cash flows, okay? When you actually have some, like property 1, 2, and 3 are probably positive by year 7. And so really, when you add up the positives and the negatives together, you're net positive 763 positive. Not even taking into account depreciation. Does that make sense?
Yeah, it's just such a small amount of money every month for the first 6-7 years. I mean, for the first 6 years, it's...
So you and I agree. However, you and I are wealthy. And for some people, and I laugh at that, but for some people, it is a struggle to come up with, where are we going to come up with an extra $2,000 a year? We're tight as it is. And I want to help the people that are tight because they're the ones that need it most, right? They're the ones that this is going to be the plan. This is going to be the one that works for them. And so I want them to understand that even though I'm showing them negative 1643, it's not even that. If they use their tax, the depreciation, cash flow from depreciation, it actually offsets that. And by year 7, they don't even need that anymore. It's actually positive for them by then. Like everything's positive.
Deliver pizzas on weekends.
Yes.
It more than makes up for it.
Yeah. So what's the worst year? The worst year is $21.95 per month. You deliver pizzas on evenings and weekends.
Per year.
Per year.
Per year.
Per year, correct. So basically, you need $200 a month. Can you do pizzas $200 a month to offset this in order to have a carefree retirement?
Yeah, that's like working like probably a 4 or 5 hour shift a week.
I don't know what pizza people make. It's got to be $10 or $15 an hour, though. You'd think, right?
Probably.
So you need to make $200 a month. Let's call it $50 a week. So you need to work, 4 hours.
Yeah.
I think that works. You hustle. And if it's two of you, if it's you and a spouse and you want to make it work, you do that. Okay? Because once you get here, it's all over. I mean, then you have great cash flow and everything just works like magic. Once you get on the positive side of that curve, it just all is magical. Okay. This is my penultimate slide. And it's a kind of interesting idea because, some of the real estate guru guys, they'll tell you, you really, ultimately, everybody wants the rental properties. They want the passive income where they're not having to do work. But what they're selling is they're selling the active, the flipping and the wholesaling models because those are sexy. And that's what the people like, they get them all worked up. Imagine what it would be if you could generate an extra $5,000 a month from wholesaling a deal a month. It's not that hard. All you got to do is find a property that you could buy at half price and wholesale it to another investor and they'll give you $5K. I mean, that's the pitch, right?
Right.
That's the abbreviated version of the pitch. So they tell you this, you go do this and go find a flip and, you'll make $30,000 on average from your flip. And, if you only do 4 of these a year, you're finding a property that's 50%, off and you kind of put some money in there and you end up selling it, you make $30,000 and everyone's happy. You can even pay, it's not the cost of the money that matters. You're doing hard money loans. It's really the availability and be able to do this. And it doesn't matter if you're paying 15% interest because, you're being able to flip these properties. You're still making $30,000. Who cares, right? That's the pitch they're doing. The challenge is, first of all, finding 50% properties you could buy for half off is one of the challenges. The other challenge is it's a job. I mean, we talk about doing pizzas and stuff like that. You hustle, you work hard in order to do flips. It is not a trivial undertaking to do these. Correct. Is it possible for people to be successful and make these work? Absolutely. There's people in our marketplace doing it. Are there a ton of them? No, there are not. Okay? And maybe in other markets there are a little bit more, but realize the people that are successful, they want all of them. It's not like they're saying, I'm only going to take 2 for the market. They're like, they've got teams out there. They're trying to do 10, 15, 20, 30 of these a year if they can. And so they're very competitive. They're very hard to do. A lot of these guys, they've got all their numbers locked in. They've got cheaper money. They've got better crews. They've got cheaper crews. They know how to do this. They're experienced. They have, they have all the things going for them. So it's really, really hard to do the fix and flip model. It's really, really hard to do the wholesaling model and be successful at it. There are people that are successful that do it. There are also professional football players and basketball players and, supermodels that look amazing and, they never get pimples and all sorts of other crazy stuff like that. So there's miracles in the world everywhere. So you can do that. This chart shows you, though, is what happens when you buy a rental property and you compared it to how much money you make with a flip. So this chart shows you that if you buy one rental property, in year 1, the amount of money you make from the rental, appreciation, depreciation, cash flow, all the stuff, if you kind of add up the entire benefit of doing the rental property, and you said, okay, if I could make $30,000 on each flip, how many flips would the rental property be the equivalent of?
Right.
So basically, in year 1, buying a single rental property is the equivalent of doing 0.44 flips.
And a lot less work.
In year 2, you already bought it. You already did all the work. All you really got to do is keep the tenant in there. In year 2, it's the equivalent of doing 0.57 flips in that year. Make the 0.57, if you make 57% of the flip money, okay, for a lot less work and less risk.
Right.
Okay? And you don't have to go find a half-off deal or anything like that. Year 3, 0.62 or 62% of a flip. By the time you get to year 20, it's like doing a flip every year that you own that rental property.
Right.
By the time you get to year 40, you're basically doing 1.5 flips a year almost. So if you have 10 properties by the time you get to year 40, it's like you're doing 15 flips a year.
Yep.
Just by having the rental properties. That's what the math works out to be. So in my opinion, it's better for you to scrimp and save and come up with nothing down, right? VA or USDA, or $1,000 down in order to do like a Chaffa loan, or 1% down for doing the 1% down conventional, or the 3% down or 5% down. Do whatever you need to in order to come up with the first one or two, instead of trying to go out there and hustle and do flips and everything, and just start getting the rentals. And then, in fact, this is the other thing I tell people. Do the rental property and then see if you want to do wholesaling or flipping, right? So go buy your first Nomad property and then say, okay, I got a year. I'm going to go buy my next Nomad property 12 months from now. That's not a worry. I got that under control. In the meantime, I do want to see if I like this flipping stuff, or I want to see if I want to do this wholesaling stuff. Maybe James is a little crazy. Maybe he thinks that it's just too much work and, he's lazy. I don't know. And so they decide, I'm going to go figure out flipping. Great. Buy your first Nomad property first, move in, live there. And then at the end of the year, buy your next Nomad property. But you have the whole year in between that to try the wholesaling thing and flipping thing. And if it works, great. You've got enough money to do your 20% down for the next property. In fact, maybe you go and you buy a super nice house and you decide you're not doing Nomad anymore because you say, flipping is the thing for me. I'm flipping 30 houses a year. Everything's magical. I've got this down. But maybe, and I only say this because I've seen hundreds of people come through NCRAG since 2003, the investor club we run. Okay, maybe, just maybe, you start off wanting to do flipping and wholesaling, and you don't quite get the traction you were hoping for. And 6 months, a year, 2 years, 3 years, 5 years later, you still haven't quite got your wholesaling or your flipping business up, and you now could have had 5 Nomad properties.
Right.
Better for you to have the 5 Nomad properties than for you to say, I'm going to do the flipping first, James. I hear what you're saying, but I'm going to hold off on Nomad. No, please don't. Do yourself a favor. Do the Nomad process in parallel, and maybe the flipping thing takes off, and then you can kind of jettison your kind of training wheels and by training wheels, I'm saying, how bad is it to have the entire Nomad model as your backup? Maybe you're going to go start a network marketing company, or you have your own network marketing business, or you invent the next Facebook or Google or whatever it is in your spare time, and you have this great business or Amazon business or whatever you're doing. Maybe you have this amazing side business that just takes off. Awesome. But how bad is it to have a $8 million, $500,000 a year in cash flow Nomad business as your backup that is very likely to succeed?
It's a good thing.
Right. There's a saying, the Navy SEALs have this amazing saying. Basically, it is 2 is 1, 1 is none.
Right.
If you don't have redundancy, some type of duplication or backup system in place, it's basically you don't have anything at all. Because once that thing fails, you're starting over, or you don't have anything to work with. And so if you don't have the Nomad as your backup plan for your network marketing, Amazon business, software design business, wholesaling, flipping business, whatever it is, if you don't have that backup, you don't have a real plan. Stock market, it doesn't matter. Whatever your plan is, you should have Nomad as your secondary backup.
Well, I remember back in 2012, when my credit was finally starting to come out of the complete dumper from my bankruptcy, you were like, I know you got all these other things you want to do, but you should think about buying a house. 2012, 13, 14, several years, you're like, you really should think about buying a house. You're really buying a house. And then I finally did it in 2015, and I've got these other things I'm doing that have finally taken off really well at the same time.
Yeah.
But I'm now in the process of, I've been making offers trying to find Nomad property number 3 for the past few weeks. And knowing that I have this Nomad retirement plan there, even though I have other business interests, which I think will actually generate my early retirement, my early 40s, it's so nice having this Nomad plan that I'm working on that doesn't take the kind of work that you're talking about here with wholesaling and flipping.
Yeah. Yeah, it's crazy when you think about when Nomad becomes the comfort backup position.
Yeah,
everything changes. I mean, because you just like, all right, no matter what, I'm going to buy a house a year, And I can be, not that you need to be, but I could be risky elsewhere because this is a really good, safe, highly likely to succeed backup plan, right? Yeah. And, the FTC wants us to say all sorts of crazy stuff like, the chance of someone succeeding at this, because no one takes action when they do this stuff, is really low because your people listen to this and they're just not going to do it. And that's why 90% of the time, no one does anything. Everyone knows this, right? I mean, think about diets. If there was a magical diet, we wouldn't have 900 different diets, guys. We would have one. It would just be what everyone does. If there's, you don't have like 37 different ways to tie your shoes. Shoelaces work. You have one solution. It works for everybody. There's maybe Velcro for a very small percentage of the population, right? So if there was one plan that just worked, everyone would just do it. But you don't. And so you have to take action and do the plan. And then the Nomad model is, you see here this all the time. There are more millionaires made from owning real estate than any other vehicle. 60% of the people that go to buy a house are able to buy a house. I mean, because there's 60% of the population that's homeowners compared to 40% that are renters. Okay. So the people that actually make an attempt to do it, they likely succeed. And all you're doing with Nomad, we showed you the numbers. It's like $168,000 is what the average net worth of a homeowner is compared to like $900 for a renter. So why not buy 10? That's all I'm saying to you. If it's so much better when you buy one, let's just buy 10 of them, one at a time. And you can decide after the first one, James is crazy. I don't know what I was thinking. Great. At least you bought a house and you're on the positive side of the curve. You buy 2, you're much better off than most people. Buy 3, buy 4, you buy 5, you buy 10. At some point, you become a believer, but trust me now, believe me later, let's get you to buy one house. I don't care where it is. Just go buy it. Get on the right side of that curve. Let the house save for you. All right, this conversation went crazy. I was in a weird mood tonight, that's for sure. So hopefully you guys liked my little rant. That is the end of the presentation. Any questions from anybody? And should I never speak again on these calls? Because I only got 2 left for the year. So that's pretty good. Any final questions? Was that helpful for anybody? I've shocked everyone into silence. Elijah says, thank you very much. You're very welcome, Elijah. Great presentation. Thank you. You're very welcome. Very, very welcome.
The comparison between the Nomad model and the 20% down model. It's really nice to see the cash flow comparison. That was even a surprise to me.
Yeah, because it scares a lot of people, right? They think, I need to put 20% down, otherwise this model doesn't work. Right. And then when you see the difference and you're like, would I rather pay $45,000 more or $53,000 more, or would I rather pay $136 a month?
So really,
even if you go 360 months, 30 years, it's better to do the 1% down.
So really the only reason to do 20% down is if you get sick and tired of moving.
Yes. That's the flush Nomad model that I just invented. I invented that last week. Jason, are you sick? You're awfully quiet tonight.
No.
He's like quiet, like his mic volume level is low.
I was just trying not to dominate the conversation like I do sometimes.
I will tell you, since I switched to the headset, I think my volume level it's been more consistent.
Yes, I'm usually on the headset. I am not tonight. That's why I'm. I probably sound like you used to.
There you go. We did a little switch. I think I look goofy with my crazy headset, but I don't know. That's just me. Yeah, Donna says sounds better. Yeah, I traded looking good for being good. So hope everyone enjoys that. I basically made it so that the sound quality was better for you guys instead of me, looking good with no headphones on. Now I look a little silly.
Hey, man, 50, 60 pounds lighter, you're looking good.
45 pounds, but thank you for the compliment. Yeah, I'm down from 270.
Nice. Congrats.
Thank you very much. I appreciate that. Yeah, Elijah says we need to flush the Greeley Nomad hybrid. Yeah. I wondered if the flush one was going to sound weird, but I think it's going to be okay. I don't know. I was thinking about calling it the rich Nomad model, basically, for people that have the down payment, but I didn't think that really kind of encapsulated the spirit of the name. I thought flush was a little bit better. So, All right, guys, we're done a little bit early. I hope you enjoyed the presentation. I will see you all next week for the call, and then we've got 2 more classes left before the end of the year, and I am working on some really cool stuff for you. Yeah, Elijah, I will see you tomorrow. So thanks all for coming on. I appreciate it. And Jason, you and I need to have some conversations about some stuff.
Perfect.
So I don't know if you want to call me on my phone as soon as we get off here, and I'm going to head to grab dinner so I can talk to you for a few minutes.
Sounds good.
All right, cool, all. Thank you very much. I will see you all soon. I'll put the video up as soon as I get it processed. So have a great night. Thanks for coming on. Bye-bye for now.